Good morning, everyone, and welcome to another deep dive here on Talk Tickers. It is Wednesday, February 4th, 2026.
And if you're looking at your screen this morning, you might be thinking your data feed is broken.
Yeah, or that you seriously missed a memo overnight, because what we're looking at today is a genuine paradox.
It really is. We're talking about Cabot Corporation, ticker CBT. They reported Q1 fiscal 26 results last night.
Okay, let's set the stage. The stock closes yesterday at $71.29, pretty normal day. Then the numbers drop, and this morning, pre-market, it's trading around $78.80.
That's a 10.5% pop overnight.
On a chemical company. I mean, this isn't some high-flying tech name. This is an industrial giant.
Right. They make carbon black. It's the stuff that, makes your tires black. Usually it's about as exciting as carbon black.
But here's the thing, and this is why we're digging in. If you just look at the headlines, this rally makes zero sense.
None. Absolutely none. The top line revenue, it was a disaster.
Let's put some numbers on that. What was the street looking for?
Consensus was about $889 million.
And they came in at?
$849 million.
Right.
A $40 million miss. And what's worse, that's down 11.1% year over year.
Wow. Okay, so in any normal world, a company shrinks by 11%, misses estimates. The stock should be getting taken out to the woodshed.
It should be down 5, maybe 10%. Instead, it's ripping higher.
So that's our mission today. Figure out what the smart money is, seeing that the algorithms are missing.
It's a tale of two companies, really. That's the only way to look at it.
Yeah.
You have the old Cabot, the tire business that's really struggling.
And
then you have this hidden growth engine inside that's just starting to fire on all cylinders.
Okay, so we're going to break that down. But first, let's just clean up the financials. If revenue was so bad, why didn't investors run for the hills?
Because the bottom line was beautiful. It's a classic story of quality over quantity. Adjusted EPS came in at $1.53.
And expectations were?
$1.40. So they didn't just beat, they smashed it.
Yeah.
By 13 cents.
That implies some serious cost control. To have sales fall that much, but profits beat so handily.
Exactly. It's discipline. And then they backed it up with guidance. They narrowed their full year range to between $6 and $6.50 per share.
Which puts the consensus estimate of $6.46 right in the sweet spot?
Right. So they're telling the market, look, the world is tough, but we've got this. We're going to hit our numbers. That's confidence.
Okay, so let's peel the onion then. You said it's a tale of two companies. Let's start with the less exciting one, the legacy business.
The reinforcement materials segment is the core. Think carbon black for tires. Goodyear, Michelin. They all buy this stuff from Cabot.
And how did that part of the business do?
It was rough. EBIT, so their operating profit, was down 22% from last year.
Ouch. 22%.
Volumes were down 7% globally. But the really scary number, for me at least, was pricing. In their key Western markets, so the Americas and Europe, pricing fell between 7 and 9%.
Whoa, hold on. A company like Cabot is supposed to have pricing power, right? They're usually able to pass on costs. If they're cutting prices, that's a bad sign.
It is. It tells you the market is weak and they're fighting for every sale. And it all comes down to a big macro story.
Which is?
Cheap tire imports from Asia. Factories in Europe and the U.S. just can't compete. So if you're a consumer, you're buying a cheaper tire made in, say, China or Vietnam.
And if the tire is made in Vietnam, the carbon black for that tire is probably also sourced locally, not from Cabot's plant in Germany.
Exactly. You're losing volume because your customers are losing volume. They said on the call, European imports are up 8%. U.S. imports up 4%. It's a flood.
So they're stuck. They either slash prices to compete and kill their margins, or they hold the line on price and lose the business.
A classic rock and a hard place. And this is why the market is actually rewarding them.
How so? That sounds terrible.
Because of how management responded. They didn't make excuses. They got on the call and acted like, the adults in the room.
What does that look like?
It looks like capacity rationalization.
Corporate speak for shutting down factories.
Pretty much. But it's a huge deal. They announced they're going to close plants in the Americas and Europe to align their footprint with this new lower demand.
They're accepting reality.
Precisely. And investors love that. It protects margins. They also announced $30 million in new cost cuts. It's all about discipline.
Okay, so that explains why the stock didn't fall off a cliff. They're stopping the bleeding. But it doesn't explain a 10% rally that has to be coming from somewhere else.
It is. It's coming from the dessert, the fun part of the story.
The battery materials segment.
This is where the narrative completely flips. While the tire business was down double digits, battery materials revenue was up 39% year over year.
39%. That's like a tech startup growth rate.
It really is. And it's profitable growth, too. This isn't some cash-burning venture. Their EBITDA margins here are running around 22%.
Very healthy. So what was the spark? 39% is great, but something specific must have lit a fire under the stock this morning.
It was a name drop. 2 words. PowerCo deal.
PowerCo, remind me.
It's the battery subsidiary for the Volkswagen Group.
Okay, so the second biggest car maker in the world. That's not a small deal.
It's massive. They signed a multi-year supply agreement. And this is so important because it validates their strategy in the West.
What do you mean?
Well, the bear case on Cabot was always, sure, you can sell in China, but when Ford and VW build their own gigafactories here, will they use you?
Because everyone's worried about local supply chains now.
Exactly. And getting qualified to be inside a car battery is an incredibly long and difficult process. This deal is VW telling the market, we trust Cabot. Their tech is good enough for our next generation of EVs.
It's a huge stamp of approval. It builds a moat around their business in Europe and North America.
Very sticky one. Once you're in that battery platform, you're in for years.
Now, you mentioned EVs, but I caught something else on the call. They kept talking about ESS.
Ah, yes. Energy storage systems.
And this is where we get the almost unbelievable connection to AI.
This is the hidden gem in the report. It's the picks and shovels AI trade that no one is talking about.
Okay, connect the dots for us. How do we get from carbon black to artificial intelligence?
Simple. What do AI models run on?
Data centers.
And what do data centers need more than anything?
Uninterruptible power. 204/7.
Bingo. The grid isn't stable enough. So these data centers are being built with massive battery backup systems, energy storage systems.
And the growth there is huge, right?
Management quoted a number. They see the ESS market growing at a 26% compound annual rate through 2030.
That's even faster than some EV projections right now.
It is. And what Cabot makes, these conductive additives, they are absolutely critical for these high-performance batteries.
Explain that like I'm 5. What does a conductive additive do?
Think of it like lanes on a highway inside the battery. Cabot's materials create super efficient pathways for the electrons to move. More pathways mean the battery can charge faster, hold more power, and last longer.
So without their secret sauce, the battery is less efficient.
Much less. And for a data center that needs to cycle power constantly, that efficiency is everything. So all of a sudden, Cabot is an infrastructure play on the AI build-out.
That's incredible. So you've got this incredible mix. The old business is being managed for cash. And the new business is hitched to the biggest growth story on the planet.
And that combination is why the stock is flying. The market is finally starting to see the value of that battery segment.
But is it safe? What does the balance sheet look like?
It's a fortress. I'm not kidding. They have $1.4 billion in liquidity. Net debt to EBITDA is only 1.2 times. For an industrial company, that is unbelievably low.
So they're not in any danger. They have plenty of dry powder.
And they're returning cash to shareholders aggressively. They bought back $52 million of stock last quarter alone.
Wow. That's a huge vote of confidence from management.
It is. And they're being smart with spending, too. They lowered their CapEx guidance for the year. So less money on old tire plants, more on the new battery stuff.
It all just clicks. It's a really clean story when you look under the surface.
It's the perfect setup for an institutional investor. Low risk, high growth, and shareholder friendly.
Okay. Which brings us to my favorite part of the show.
Time to put on the hedge fund vest.
That's right. This is not financial advice segment. Everyone listening, please do your own research. We are just talking here. But if we had to pitch a trade based on this, what's the idea?
All right. I'm calling this one the dirty data center ARB.
The dirty data center ARB. I like it. Lay it out.
Okay. The thesis is this. The most crowded trade in the world right now is long AI. Everybody owns NVIDIA. They own the utilities.
Right, and you're paying a huge premium for those names.
A massive premium.
Yeah.
But the real bottleneck for AI isn't just generating power, it's storing it. The grid is fragile. You need batteries.
Okay, makes sense.
But here's the ARB. The market hates battery stocks right now. EV sentiment is terrible, sales are slowing, and so anything with the word battery in it has been crushed.
So you have a supply-demand mismatch in the market itself. High demand for the technology, low valuation for the stocks.
Exactly. And Cabot is the perfect way to play that mismatch. It's still priced like a grubby, cyclical, low multiple tire supplier.
But hidden inside is this high-growth tech asset.
That's the trade. You go long CBT, you're buying the battery materials division, this AI-adjacent energy storage unicorn, for the price of a rubber company.
You're arbitraging the bad sentiment around EVs against the amazing reality of data center demand.
You are. And you wait for the re-rating. As the reinforcement business stabilizes from the plant closures, the battery business will become a bigger and bigger piece of the profit pie.
And eventually the market has to wake up and slap a tech multiple on it.
That's the catalyst. The stock goes from a 10 times multiple to a 20 times multiple. And you get paid a nice dividend to wait for it to happen. It's a beautiful structural trade.
That is actually a really compelling idea. The dirty data center arm.
Again, just an idea, not advice.
Of course. But it's a fantastic way to frame the opportunity here. Okay, let's bring it home. A quick recap for everyone.
Cabot gave us a masterclass. They missed on revenue because their old market is in a trade war. But they beat on earnings because they're being disciplined, cutting costs, and managing for cash.
And the growth story.
The future is all batteries. The VW deal is the validation, and the data center boom is the rocket fuel. The market is just starting to wake up to it today.
They're managing the decline of one industry to fund their leadership in the next, and today the market decided that's worth a 10% premium.
A pivot that is definitely worth watching.
Keep your eyes on the ticker, everyone. Thanks for joining us for this deep dive.
See you next time.